Welcome to the Deep Dive, where we pull out the absolute must-know insights from fascinating sources to get you well-informed and fast.
Yeah, really fast.
Today, we're jumping into a book that's just packed with, well, frankly, counterintuitive wisdom about money. It's Nick Maggiulli's Just Keep Buying, Proven Ways to Save Money and Build Your Wealth.
And it kicks off with this amazing personal story.
It really does. Tell us about it.
Okay, so imagine this. McGilly's own grandfather. The man had a serious gambling problem, right? Regularly bet away half his monthly retirement income.
Wow. Okay.
But here's the kicker. The author figured out that if his grandfather had just consistently invested the other half, the half he wasn't gambling away, into the U.S. stock market, despite everything else, he would have died a millionaire.
A millionaire. Just from investing money he was basically already writing off. That alone just changes how you think about things.
Totally. And it led McGilly to this really simple but powerful three-word mantra. Just keep buying.
Just keep buying. Simple.
So our mission here today is to really distill the most impactful, often surprising nuggets of knowledge from this book.
We're trying to give you a shortcut to some solid personal finance wisdom, all backed by actual data, not just, opinions or beliefs.
Exactly. To help you navigate your own financial journey. So let's get into it. Where does he start?
Well, right off the bat, Maggiulli challenges this idea that there's universal financial advice, like one rule fits all.
Yeah, that never really feels right, does it?
No. He argues that what you should focus on saving or investing totally depends on where you are financially.
Okay, that distinction feels important. You know, someone just starting their career versus someone who's maybe built up a bit of savings already.
Precisely. And he introduces this concept. He calls it the save-invest continuum.
The save-invest continuum. Okay, how do you figure out where you land on that?
It's actually pretty simple. Basically, you just compare your expected annual savings to your expected annual investment growth.
If your savings number is higher, your main focus should be saving more. If your investment growth number is higher, then you should probably spend more energy optimizing your investments.
And if they're close,
then you got to do both. Focus on saving and investing.
Right. And what's interesting is how this focus changes naturally as your wealth grows. He uses this example, doesn't he? A 40-year saver.
Yeah, it's a great illustration. Early on, maybe you save $10,000 a year. That $10 K completely dwarfs, say, a $500 investment return you might get on your small starting pot. Saving is obviously king then.
Makes sense.
But fast forward maybe 20 or 30 years, you've built up, let's say, $500,000. Now, your investment returns in 1 year could easily be over $31,000. That's way more than the $10,000 you're still saving annually.
Ah, so the balance shifts completely.
Exactly. The core insight is saving is your most powerful tool at the start. But over time, as your capital grows, investing becomes the main engine. By the end of that 40-year period he modeled, almost 70% of the total wealth came from investment gains, not the annual contributions.
So your wealth level isn't just a score. It's actually telling you where to put your energy saving hard or investing smart.
You got it.
Okay, so if we know where to focus, the next big question is obviously, how much should we actually save? And Maggiulli kind of throws out the standard rules here too, like the whole save 20% of your income thing.
He really does. He points out those rules assume things that just aren't true for everyone, like stable income, and that everyone can save the same percentage.
Which feels unrealistic. Life happens, incomes fluctuate.
Exactly. And the data backs this up. Income volatility has gone way up over the last few decades. Plus, and this is critical, how much people save is super closely tied to their income level.
Oh, really? How so?
Well, the data he cites shows the bottom 20% of earners save maybe 1% of their income, basically nothing. Meanwhile, the top 1%, they save over 50%. So that 20% rule is just not achievable for a huge chunk of the population.
It reminds me of that biology analogy he uses, the fish. The Dolly Varden chart.
Oh, yeah. The one that literally shrinks or grows its digestive tract based on food availability. Phenotypic plasticity, I think it's called.
Right. It's a great metaphor for needing our saving habits to be adaptable, flexible, not some rigid rule we beat ourselves up over.
Totally. So the actionable advice is save what you can save without stressing yourself out constantly. Figure out your fixed costs, then get a handle on your variable spending.
Yeah.
He suggests maybe using a dedicated credit card for variable stuff, paid off each month just to see where it's going.
And he actually suggests you might need to save less than you think. That sounds nice.
Yeah, it's kind of reassuring. He points to data showing many retirees don't actually spend down all their assets. They often end up leaving more behind than expected.
Okay, that's definitely against the usual grain, which kind of leads perfectly into another bold claim he makes. What does he call the biggest lie in personal finance?
Yes. He says the biggest lie in personal finance is that you can be rich if you just cut your spending. He really goes after that whole skip the latte, become a millionaire narrative.
The latte factor, yeah, I've heard that one. But he uses data to push back.
Hard data from the Consumer Expenditure Survey. For the lowest 20% of earners in the U.S., they're spending on just the absolute necessities, food, housing, healthcare, transportation, already adds up to more than 100% of their take-home pay.
More than 100%. Wow, so there's literally nothing to cut.
Exactly. Their average monthly income might be around $1,000, but just those four basics cost them nearly $2,000. It's not about willpower. There's just no margin.
So where does the extra money come from? Debt? Assistance?
Presumably, yeah. Debt, government assistance, family help. The point is, cutting spending isn't the solution for them. He explains this with the concept of diminishing marginal utility, the law of the stomach. Meaning, as your income goes up, the percentage you spend on necessities goes down. You can only eat so much food or live in so many houses, so richer households spend way less of their total income on basics. Increases in income don't automatically mean equal increases in spending for most people.
He even mentions studies about poverty traps, right, in Bangladesh and Kenya.
Yeah, showing it's often the lack of initial capital, not a lack of motivation or discipline, that keeps people trapped in poverty.
So the takeaway is pretty stark. Cutting expenses is fine, check for waste, obviously. But the real path to wealth consistently is growing your income and then investing that income in things that generate more income.
Absolutely. Focus on building your human capital, your skills, your knowledge, your time. Sell expertise, offer services, teach, create products, climb the ladder, whatever it takes to increase your earning potential.
And ultimately, aim for ownership.
Ownership is key. That's how you convert that human capital into financial capital that works for you.
Okay, so earn more, invest wisely. But what about spending the money we do have? We all struggle with guilt sometimes. He talks about this, right? Contrasting these two extremes.
Yeah, James, who just spent money without even thinking about prices, and Dennis, who was like paralyzed with anxiety over Uber surge pricing, two ends of the spectrum.
And the problem is that a lot of financial advice uses guilt as a motivator, which can backfire and make even wealthy people anxious. You mentioned that stat.
Right. A survey found 20% of investors with $5 to $25 million were still worried about having enough for retirement.
Crazy. So what are his solutions for guilt-free spending?
Two main ones. First, the 2X rule. It's simple. Anytime you make a significant splurge, immediately invest the same amount in income-producing assets. Or donate it, if you prefer.
So you balance the immediate pleasure with future building.
Exactly. It cancels out the guilt. Could be $10, could be $10,000. The principle works. You enjoyed something now, and you also boosted your future self.
I like that. What's the second solution?
Focus on maximizing fulfillment, not just chasing momentary happiness. He uses running a marathon as an example, often deeply fulfilling, but parts of it are definitely not happy.
Right, satisfaction versus just pleasure.
Yeah. Use your money as a tool to build the life you actually want. Align your spending with things that bring long-term fulfillment, like developing skills, gaining autonomy, pursuing a purpose.
That's a much healthier way to think about spending. And speaking of spending more as income rises, lifestyle creep, usually painted as this terrible villain. He mentions the Vanderbilts.
Oh yeah, the classic cautionary tale. Squandered a massive fortune in just a couple of decades. Smoking cigarettes rolled in $100 bills, building ridiculous mansions. Extreme lifestyle creep.
But Maggiulli says, maybe a little creak is okay, even good.
More than okay. He argues it could be satisfying, and the data suggests you can actually spend up to 50% of your future raises without derailing your retirement plan significantly.
50%? That's way more than most advice suggests.
It is. So his simple rule is, half of every raise is for you now. That's your lifestyle creep. Enjoy it. And the other half is for future you. Goes into savings investments. It fits perfectly with the 2X rule, actually.
That's a really practical, balanced approach. Okay, so we've rethought saving and spending. Let's pivot to investing itself. How does he approach saving for big, specific goals, like a house down payment?
Time horizon is everything here. That's the key takeaway. For goals that are pretty close, say, within 3 years, he argues cash is generally the best bet. Inflation won't hurt that much over such a short period, and you need the certainty. If you need $24,000 in 2 years, saving $1,000 a month in cash gets you there, predictably.
But for longer-term goals, more than 3 years out.
Then bonds usually start to make more sense. They generally offer a better return than cash, helping to offset inflation's bite over time. His example was a $60,000 goal in 5 years. Bonds might get you there in 60 months, while cash might take 67 months.
And stocks. Where do they fit in for these kinds of goals?
That's the big caveat. Stocks have higher average returns, sure, but they're volatile. A market downturn could happen right when you need the money, potentially delaying your goal significantly. So for a specific medium-term goal, that risk might be too high. Time horizon dictates the tool.
Got it. Makes sense. Now, zooming out, why should we invest at all? He lays out 3 core reasons.
Yep. First, pretty straightforward. You're saving for your future self, providing resources for when you can't or don't want to work anymore. He mentions that cool experiment where people saw digitally aged photos of themselves.
Oh, yeah. And they saved more.
They allocated about 2% more to retirement savings afterwards. Seeing future you makes it more real.
Okay, reason 1, future self. Reason 2.
Preserving your wealth against inflation. He calls inflation an invisible tax, which is a great way to put it. It just silently eats away at your purchasing power.
Like that Henny Youngman joke about groceries costing so much. Or the extreme example of Weimar Germany.
Exactly. And investing is the primary defense.
Yeah.
He shows how $1 back in 1926, just left as cash, would only have the purchasing power of about $15 by 2020 because of inflation. But that same $1 invested in U.S. stocks, it would have grown to over $10,900.
Wow. Okay, that difference is just staggering. 15 versus almost $11,000. So, yeah. And the third reason.
To replace your human capital with financial capital.
Explain that one.
Your human capital is your ability to earn money, your skills, knowledge, time. Over your working life, that naturally declines or eventually ends when you retire. Investing is how you convert that earning power while you have it into financial assets that can then generate income for you later on.
So you're building a money-making machine to take over when your personal earning power fades.
Pretty much. He even talks about quantifying your human capital, like the present value of all your future expected earnings. A 50-year job for 40 years could be worth something like $1.2 million today if you discount it properly. It highlights what a huge asset your earning potential is.
Especially for people like athletes, right? Short earning careers.
Exactly. They had to convert that human capital into financial capital aggressively while they can.
Okay, so investing is crucial for future you, fighting inflation and replacing earning power. Now, what should we actually invest in? He seems pretty open-minded here.
Yeah, he stresses there's no one true path to wealth, like that judo philosophy he mentions. Different things work for different people. But he focuses on income-producing assets.
Right. What are the main categories he covers?
Well, there are stocks, obviously. Ownership in businesses. Great historical returns, but you deal with volatility. Then bonds, essentially loans. Lower volatility, safer, good for balancing things out, but lower returns.
What else?
Investment property real estate. Potential for leverage, which is powerful, but it's a lot of work, high maintenance, and hard to diversify properly.
True.
REITs, real estate investment trusts, offer a way around that real estate exposure without being a landlord, often with decent dividends. Farmland is interesting. Low correlation to stocks and bonds, good inflation hedge, but very illiquid, hard to sell quickly.
Okay, getting more niche now.
A bit. Small businesses or angel investing, huge potential upside, but also a very high failure rate and demands a ton of your time. Royalties, like from music or books, can provide steady income, often uncorrelated with the market. He brings up the Lindy effect here.
The Lindy effect.
Yeah, the idea that the longer something non-perishable, like an idea or a song, has been around, the longer its future life expectancy is likely to be. So royalties from older, proven works might be more reliable.
Interesting. Okay. Any others?
Finally, creating and selling your own products. Offers full ownership, potentially great satisfaction, but it's super labor intensive and there's absolutely no guarantee it pays off.
And he specifically leaves out things like gold, crypto, art.
Right, because they don't inherently produce income. Their value is based on what someone else is willing to pay for them later, which is more about speculation than investing in cash flows in his view.
Okay, so focus on income-producing assets. But within stocks specifically, he has strong words about trying to pick individual winners, doesn't he? He tells that GameStop story.
Oh yeah, his friend Darren losing $12,000 in like 2 hours during that whole GME frenzy in 2021. It's a brutal illustration of the emotional roller coaster and, frankly, the sheer luck involved.
And the statistics aren't kind to stock pickers either, even the pros.
Yes, not at all. He cites that 75% of professional fund managers fail to beat their benchmark index over 5 years. And even more striking, research shows that something like the best-performing 4% of all listed companies since 1926 account for all the net gains in the entire U.S. stock market.
Only 4%, so most stocks are duds, or just average.
Pretty much. Most individual stocks don't actually contribute much to the overall market return. The huge gains come from a tiny fraction of massive winners. And the core problem is, it's incredibly hard to tell if someone picking stocks is skillful or just lucky. The feedback loops are too long, and too many external factors interfere.
So unless you're literally treating it like gambling money, you can afford to lose.
Yeah, his advice is clear. Avoid picking individual stocks. Stick with broad, diversified index funds. Buy the whole haystack instead of searching for the needle.
Okay, solid advice. Now let's talk timing. When should you invest? If you have a lump sum, do you put it all in at once or ease in? And what about waiting for a dip?
His stance is pretty firm here. Act now, don't wait.
So buy now versus average in.
Exactly. Buy now is investing all your available cash immediately. Average in, like dollar cost averaging, is spreading it out over time. His analysis, looking across different assets and time periods, consistently finds that buy now beats average in somewhere between 60% and 80% of the time over 12-month periods.
Why is that?
Because markets tend to go up over time. While you're waiting to average in, the market is often rising, meaning your later contributions buy fewer shares. On average, averaging in underperforms lump sum investing by about 2.5%.
Okay, so statistically, getting the money in sooner is better. What about the idea of waiting for a market crash, buying the dip?
That's an even worse strategy, according to the data. Even if you had perfect foresight and could magically time the exact bottom of every dip, you'd still likely underperform just systematically investing over the long run, like with dollar cost averaging.
How can that be? Buying at the absolute bottom seems like the best move.
Because while you're sitting on the sidelines waiting for that perfect bottom, the market spends most of its time going up. You miss out on way too much compounding, waiting for those infrequent, unpredictable dips. It fails in over 70% of 40-year periods going back to the 1920s.
Wow. So trying to be clever about timing usually backfires.
Pretty consistently, yeah. And if putting a lump sum into 100% stocks feels too scary, his advice is to use the buy now approach, but with a more conservative portfolio, like 60% stocks and 40% bonds. You still get the benefit of immediate investment, but with less volatility than averaging into 100% stocks.
So the message is loud and clear. Invest as soon as you have the money and as often as you can. Don't wait for better prices.
Yep, just keep buying.
But inevitably, the market will dip. Sometimes it crashes. How should we handle that volatility? He tells that amazing FedEx story.
Right, Fred Smith literally gambling the company's last $5,000 in Vegas to make payroll. An extreme example. But the point is, sometimes the biggest risk is not taking action.
So how does that apply to market volatility?
Maggiulli argues that volatility is basically the price you pay for the higher returns stocks offer. Market drawdowns are normal, completely expected. The S&P 500 has had an average intra-year drop of almost 14% every year since 1950.
14% average drop within the year? Wow, okay.
Yeah, so if you try to sidestep every little dip, you'll be out of the market constantly, and your returns will suffer massively compared to just buying and holding.
He actually reframes crashes not as disasters, but as opportunities, like that Rothschild quote.
Buy when there's blood in the streets.
Yeah.
Exactly. He emphasizes the math. If your portfolio drops 33%, you need a 50% gain just to get back to even. If it drops 50%, you need a 100% gain.
So buying after a big drop means your potential future returns are much higher.
Significantly higher. Buying during a major crash, like in March 2020, after a 30% plus drop, historically leads to much higher expected returns over the next few years, potentially 20% or more annualized during the recovery.
So instead of panicking during a crash,
see it as a sale. A chance to buy future growth at a discount. Historically, after those big 30% plus drops, the market often delivers really strong returns, sometimes over 10–25% annualized in the following years.
So stay calm, and if you have cash available, consider putting it to work during a crisis. Don't let fear win.
That's the message.
Okay, so we've held through volatility. Eventually, we might need to sell. This is often the hardest part emotionally, right? What's his advice on selling?
His main principle is kind of the opposite of buying. Sell slowly, not quickly, and only for specific, good reasons.
What qualifies as a good reason?
He gives three main ones. First, to rebalance your portfolio. If you started with, say, 60% stocks and 40% bonds, over time, the stocks will likely grow faster, pushing your allocation maybe to 70-30 or even higher.
Which increases your risk level.
Right. So rebalancing, selling some of the winners, stocks, and buying more of the underperformers, bonds, brings you back to your target allocation and controls risk. He suggests doing it maybe once a year to keep it simple and minimize costs. Or, if you're still adding money, you could do accumulation rebalancing. Just put your new contributions into the asset class that's underweight.
Okay, rebalancing. What's reason two?
To get out of a position that's become too concentrated or is consistently losing. Having too much wealth tied up in one single stock, even if it's done well, is risky. Sometimes it makes sense to sell some, maybe to diversify or achieve another goal, like paying off your mortgage. The crucial part is having a pre-planned strategy for when and how you'll sell, to take emotion out of it.
Makes sense. And the third reason?
The most obvious one, to actually use the money. To meet your financial needs or fund your life goals. What's the point of building all this wealth if you never benefit from it?
Right, he has that line.
Fund the life you need before you risk it for the life you want. And remember the diminishing returns of wealth on happiness. That first million makes a much bigger difference to your well-being than the second or third million.
Powerful reminder. Okay, one last practical piece. Where to invest. Specifically regarding tax-advantaged accounts like 401k or IRAs. That moment you see your first paycheck and think, hey, where'd the rest go? Taxes.
We've all been there.
Yeah, so the big question is often traditional versus Roth. The key difference boils down to when you pay the taxes.
Traditional means tax break now, pay taxes later in retirement.
Correct. Roth means pay taxes now, get tax-free withdrawals in retirement. The decision ideally rests on whether you think your income tax rate will be higher now while you're working or later when you're retired.
Which is hard to predict decades out.
Very hard. Future tax laws, your future income.
Yeah.
It's guesswork. That's why he suggests maybe using a mix of both traditional and Roth accounts if possible. It gives you flexibility and hedges your bets against future tax changes. Okay, but here's another curveball he throws. Maybe don't automatically max out your 401k. That goes against almost everything you hear.
It does. His argument is that the actual annual tax benefit of a 401k compared to a well-managed regular taxable brokerage account might be smaller than people think, maybe around 0.5% to 0.75% per year.
That doesn't sound huge.
Not enormous. And the trade-off is locking up that money for potentially decades. If you have other important goals before retirement, buying a house, starting a business, needing liquidity, maybe putting all your available savings into a retirement account isn't the optimal move.
So think about your overall goals first before just blindly maxing out retirement accounts.
Exactly. Consider a balanced approach. Use the tax-advantaged accounts, yes, but maybe not to the absolute maximum if it compromises other important financial objectives.
Fascinating. Okay, we've covered a ton of practical stuff, but Maggiulli also gets into the psychology, the mindset of wealth. He asks why you will never feel rich, even if you are. He uses that lottery winner story.
Jack Whitaker. Yeah, a guy who's already worth $17 million won another $113 million in the lottery and still managed to lose it all and died broke. Why? He was still playing the lottery even after winning big because he said he just didn't feel rich.
That's hard to comprehend, but it's not just extreme cases, is it?
No. He tells a story about his own friend, John, who was objectively wealthy but felt not that rich just because his other friend, Mark, came from an even wealthier family. Even billionaires like Lloyd Blankfein have famously claimed they aren't rich, just well-to-do.
So what's the insight here?
It's that rich is almost entirely relative. Unless you're literally the richest person on the planet, there's always someone wealthier you can compare yourself to. Your peer group, your aspirations, they constantly shift your perception of what rich even means.
So the takeaway is, be mindful of that comparison trap. Remember who might be looking up at you.
Exactly. Practice some perspective. Which leads perfectly into his final and maybe most profound point. Identifying your most important asset.
Which isn't money.
No. He starts with that thought experiment from Peter Attia. Would you trade places with Warren Buffett, get all his billions, but you have to be his age? Or would you rather keep your current age and zero fortune?
Most people would choose youth, right? Choose time.
Almost everyone. It instantly reveals what we subconsciously value most. Then he tells that incredible story of Dashrath Manji, the mountain man in India.
The guy who carved a road through a mountain.
By himself. With just a hammer and chisel. It took him 22 years. He didn't have money or resources, but he had time and incredible determination. He shortened a village's journey from 34 miles to just 9 miles.
An amazing story of what time and effort can achieve.
And that's the ultimate insight Maggiulli leaves us with. Time is your single most important asset. You can always, theoretically, earn more money. You can never get back more time.
How you use your time, especially in your younger decades, your 20s, 30s, 40s, has this immense leveraged impact on your future life.
Absolutely. He connects it to the happiness U-curve research, too.
Hmm.
How we tend to overestimate our future happiness when young, leading to a midlife dip when reality doesn't quite match expectations. Then, as we age, our expectations adjust, and pleasant surprises actually make us happier again.
We start as growth stocks, full of potential and maybe unrealistic expectations, and end up as value stocks, perhaps wiser and more appreciative.
That's a great way to put it.
So wrapping this all up, Nick Maggiulli's Just Keep Buying really boils down to a set of powerful, often data-driven rules for building wealth in a sustainable, less stressful way.
Yeah, you can think of it in maybe 3 core shifts. First, rethink how you save and spend. Know where you are on the save-invest continuum. Save what you can. Don't kill yourself over it. Focus more on growing income than tiny cuts. Use that 2x rule to spend guilt-free. And allow for some lifestyle creep like half your raise.
Okay, shift 1, saving and spending sanity. Shift 2.
Invest strategically and, crucially, unemotionally. Use cash for short-term, bonds for medium-term goals. Invest consistently because you need to save for future you, beat inflation, and replace that human capital. Definitely avoid individual stock picking for serious wealth building. Buy quickly, don't wait, or time the market.
And don't panic in downturns, view them as opportunities.
Exactly. See, volatility is the price, crashes is sales.
Got it. And the final shift.
Master your financial psychology and prioritize time. Understand debt is a tool. Use it wisely. Buy a home when it makes sense for you. Sell investments slowly based on preset rules, not fear. Remember, wealth is relative. And always, always fund the life you need before you chase the life you just want. Because at that time, you can't get it back.
It's a really holistic approach. So thinking about all these insights, it leaves us with a final thought for you, the listener. What's the one single action you can take today, based on everything we've discussed, that could make the biggest difference to your financial future? And maybe just as important, how will you make sure you're prioritizing your truly most important asset, your time? Lots to chew on there.
Definitely. We hope this deep dive gave you some valuable perspectives to apply to your own journey. That's all for this deep dive. We'll see you next time.